the center of the channel, and then the market's still moving up. So now they're down at the bottom of the channel.
Hey guys, welcome to the Proving Ground review. We're going to get started in about 4 minutes. Just kind of going back to a conversation we're having with somebody here in person. So the reason why that happens is that you're getting more volume put into the market. So I think the disconnect for me is that I'm not seeing what most of the miners in the market trade on because I don't pay attention to that stuff. So the only thing I can deduce out of the situation is that miners at some level, pivot point or whatever it may be, major level, psych level, short, dump tons of them just start dumping money in the short end, which gives the majors the ability to continue to push the threshold. So all of a sudden you got all these new trades coming in, and the majors see that opportunity to just continue to push in the initial direction. And that's the only way that you would get that widening and the majors to drop back from the overbought into the channel. And it doesn't happen often. Usually it happens like we saw it in Brexit, because Brexit was drawn out. It wasn't like an announcement came out and then within a couple hours and an hour, the market normalized and everything was fine. Brexit was like all night type of thing. Right. And as soon as that happened, I mean, you could jump in and you could use a 5 minute, and every time you saw even just a little blip to the long side, you could short that sucker and be just fine. Right. I mean, everybody cleaned house on Brexit. Honestly, I took like 100 pips and I stayed out of the rest. I was happy with that. I was like, yeah, I'm good. And guys are like, what? I took like this and that. I'm like, good for you. 100 pips is like 10 times what I normally go for. I'm good. But it was clear and concise, and it went on for hours. It wasn't just like this initial, like you knew what it was doing. It was just going to continue in that direction. And Cameron, I know you're more familiar with this than most of our guys, but you can see how the indicators react in particular situations to be able to call to a certain degree what that announcement's going to do, which is very dangerous to speak out loud because most people are like, well, I want to figure that out. For the most part, I just stay away from it altogether.
Since I started trading longer term, I'm bad. I don't check the announcements like I should.
Yeah, I've only made that mistake a couple of times. And both times they cost me, luckily, because if they didn't cost me, I probably wouldn't have learned my lesson.
In case something goes crazy,
Mm-hmm.
I've found that the announcements, even the red announcements, make almost no difference if you're going for 20 plus pips over a 24 or 48 hour period.
Right. So you got enough room to grow in either direction.
Yeah.
Yep. Hey, John. Good evening.
If you get a good signal on your 4 hour and 2 hour chart with a 20 pip stop loss or hedge,
yeah,
you can usually depend on it regardless of what the announcements do.
Absolutely. Absolutely. Somebody want to hit those lights for me? Put them at about 50% or something. Can you guys see the screen okay? Is it projecting?
Yeah, it looks good.
Good. John, can you see my screen and hear me talking? I just want to do a quick check before we get started here. John Stacy online. All right. We're going to get started here with the Proving Ground review. Just in just a second, I want to make sure that our feed for our online members is working okay. Can you guys see my screen and hear me talking online? All right, well, I'm going to continue. So if you guys can't, I'm sure at some point you guys will let me know. Let me just double check my sound here, make sure. Yep, okay. Awesome. Thank you. Thank you, Lawrence. Paul, thank you. John, thank you. Perfect. Brad, thank you very much. All right, guys, let's go ahead and get started. Welcome to Proving Ground Review. So I want to open it up to questions today. Otherwise, we'll cover the duckbill on the 1 day. I just kind of pulled that out of my tail. So, but if you guys have questions, definitely want to address those. And awesome, Lawrence. We'll do. Thank you. I know that Cameron's got some stuff that he wanted us to look at, and so I want to take a look at that for a second. But first, before we get started, does anybody have any questions? Yes, sir.
How do we identify long-term trend changes better?
How do we identify long-term trend changes better? I actually had a conversation with somebody about this just the other day. So let's look at, I like to identify my trends on a 240 or a 1 day. So let's use a 240. And we'll take this step by step. Feel free to stop me at any point to get clarification. Sometimes I talk faster than I intend to. All right, so this is a great example. Let's go back here and let's look at this right here. So this is euro versus US dollar, 816. And we're going to go back. Actually, let's go back further. To do that, I'm going to have to go here and let's just do 500. That way we're not sitting here all night. All right, wait for that to load. Okay. Let's pull this back a little bit. So let's start from this point right here, this drop forward. And let's go back to about here. Okay. So we can see this is a downtrend, right? And this is on a 240 minutes. So this is over the course of, let's just call it from this point right here, February. But if we try to channel that, we're going to be cut off, right? So we're not going to channel that. Let's try to channel this. We see we're kind of in a down right there, right? Okay. So we're not going to use this big drop because that tends to skew the bottom. You can see how the bottom pops out. I don't like that. So let's use this slope right here. I like to find a clean slope where I can pick up tops and bottoms and get validation on both, right? Let me stretch that out. All right. So let's say we're just looking at this trend, and this is like 731 to 819, so that's pretty significant. We have tops and bottoms touching, so top, middle. So if we put in, say, a fib level, 50%. Boom, look at that. Beautiful. That's sexy. I like that. All right. Let's add a couple more lines here. Okay. So first of all, how do we identify trend? It's when the highs of a peak are lower than the previous highs and the lows of the valley are lower than the previous valley. So lower lows on both the highs and the lows. So low lows, high highs is when we're going up, right? Higher high, higher low would be when we are when we're seeing an uptrend, and lower lows and lower highs is where we're seeing a downtrend, right? So let's draw this out. You guys probably don't need the drawings most of the time, but I do. So I'm going to draw. So for this particular range, we can see that we have a high right here, and then we go down, we come up, make another high that's lower than the previous high, go down, and we can just call this a single down. That's kind of a small up. It's probably short term or low volume, right? Down, so this is all one down, and then an up, which is lower than the previous high. So then we would expect either a low lower than this low, or to start breaking our highs, which is up here right now. Okay, so let's go forward, and I'm going to draw a line on our barriers. Just high, low. Those are our barriers. Either we break this bottom line and continue in a downtrend, or we break this top line and either start to consolidate or start trending in an opposite direction. Didn't break it yet, right? A lot of times when we get close, we just start to consolidate, right? We did kind of break the channel, which is a lot of times your first indication, right? But a lot of times, depending on how you draw it, because your channel is based on your opinion, sometimes your opinion may be wrong, right? It may not very well be right there, right? It might be a little bit higher or what have you. So we broke out here, and we obviously broke out. It's not just the wick, it's the body that broke out of our channel right here. And then we used it as support, which is also a really good sign. If we break below it and use it as resistance, that's a really good sign. If we break above it and use it as support, that's usually a good sign that we're breaking out of that. So just kind of a, note to self, right? But we're still waiting to break this top high right here, because if we don't break this with body for at least a few candles, we're likely to just consolidate until the market picks an overall direction. So let's continue to follow this. You can see, look at that. It got close. It's still pulled back. So it's still downtrending technically, right? We can see a lot of cause for reservation in that particular downtrend, and likely that we're just consolidating. Let's continue. Now we've broken the high of that previous high. In addition to that, we created a low before that that was higher than the previous low. So now we got two forms of validation telling us that we could be changing trend directions, right? And even if you don't feel like we're absolutely changing trend directions overall, this could be a short-term change in trend. So if you're trading intraday, right, just going for 10, 20 pips throughout the day, you probably want to rely on this short-term up more than you are the long-term down, right? Because if we really backed it up into the grand scheme of things, we're in a downtrend overall. But if all we did was try to trade down and got caught up in this stuff as it moved up, we'd really be missing a lot of opportunities. And that's fine if that's your approach. I know guys that only sell, literally only sell, right? And in the Forex, you think about that and it's like, okay, Euro versus US dollar, what's the dominating pair on Euro versus US dollar? Euro, right? So US is secondary. So what about the British pound US dollar? Pound US is secondary. So what about the USD JPY? The dollar is primary, right? So if I only sell, it doesn't really make a lot of sense. For me, for them it does, because that's their psychology. That's the way they function, right? So if I only sell, then if I'm selling the Euro US, GBP USD, I'm basically going in favor of the US dollar. But if I only sell the USD JPY, I'm going in favor of the JPY and against the US dollar, right? So if you think about it from a logical standpoint, it doesn't make sense, but that's not the purpose. The purpose is emotional, right? And that's the important part. I'll give you an example. I used to be a small business consultant, and small business consultants run into companies that are suffering, right? And so I'd go into a company, and generally I worked with call centers. So I'd go into a company and they had some pitfalls and they were trying to figure out how to get into the positive. And most commonly, the one thing that they tried to do was to do things logically by deductive reasoning, right? So in my personal life, if I want to make more money or be more financially sound, then I need to budget correctly, right? And that's personal is different than business. So with that deductive reasoning, the CEO would usually hire a CFO, Chief Financial Officer, right? CFOs are number crunchers. For those of you guys that are CFOs, I hate you. No, I'm just kidding. They're analytical guys, right? They crunch numbers. So case in point, we'll look at Vivint. I didn't consult for Vivint, but here's a good case in point because you guys all know who Vivint is. Vivint, before they sold to Blackwell or Blackstone, they brought in a new CFO, and the new CFO started to tighten things up, right? So all the perks like gas benefits for their techs that would drive around company cars for their techs, bonuses, all that stuff started to go away, right? We're going to tighten up so our bottom line makes more sense. So when we go to market, we're worth more, right? Well, what happens when you take away people's carrot? They stop performing, right? That's right. But logically, it makes sense. Well, if we cut out all this extra stuff, we'll have more money. Well, no, because it's because of the extra stuff that you're getting the extra sales, right? So you spend $1 to make $5. That's how it works, right? But to a number cruncher, that's not how it works. Here's the analytical aspect. So these companies would do this. The difference is that if you don't have a CEO with the pair on him, he's not going to set the CFO. He's not going to offset the balance. It's like yin and yang, right? So the CEO will say to a CFO when there's a preferable balance, I understand why you want to cut those things and why you think based on your spreadsheet that makes sense, but let me show you why that doesn't make sense, right? And so I'm going to fight for these things, and then we'll compromise on these other things. So it's like a good marriage, right? So it's like, okay, I'm going to go fishing every other Saturday, not every Saturday, right? So and then for bonus points, it's like one Saturday a month, right? And then you're sure to have more kids, promise you. So anyway, so it's the difference between emotional and the psychological facet. So when we think about things like someone's approach or your own approach, you might want to consider your personality and your risk appetite, and not just what makes sense logically, because what makes sense logically is not always the best approach for you. What makes sense logically is Hiram should not be a trader. That's what makes sense logically, because I don't have the personality for it. But I've created an approach to the market that suits my personality and my risk appetite, and I made it. And the only way that I've been capable of doing that is because I have the tools and resources that allow me to do that. If I was trading with a cookie cutter approach, which is how most people trade, right? But look, I talked to a lot of guys, and for those of you guys that traded before, it was always the same rhetoric, right? Candlestick patterns, support and resistance, trade with the trend, all that stuff, right? It's always the same thing. Well, the RSI says this, and the Bollinger Bands say that, and you got your EMAs and your stochastics, and it's all the same stuff that everyone else has. And that's why you can talk the same language as everyone else that's losing, right? So it's all a cookie cutter approach. There may be 10 different models, but it's all the same approach. So you step out of that and you're able to see something that you can take from your own perspective, like the indicators. For example, before I got here, the only person that pattern trade was Senior, and I didn't even know that until after a year into proving most of my patterns within the proving ground. And then someone approached me and said, hey, Senior tried this before as well. Looked at his patterns. Obviously, Senior's like next level, and so some of the stuff that he threw out was way over my head and a little more complicated. After a while, I kind of gravitated to it and figured it out, me and 3 other guys. But it definitely has more than the parameters that we have for most of our patterns. But it's kind of the same approach. Some people will take a pattern-based approach to the market primarily, and then secondary try to take another approach, predictive or reactive. Or most people will just take a reactive approach to the market, meaning if the majors and minors point down and pressure's in your favor, trade down, right? And then there are some of us that trade predictive, right? So it doesn't necessarily have to point in your direction in order for you to take that trade in the direction you want to take it, right? For example, the follow-up to hiccup pattern, and the majors and minors are up. A lot of times pressure is even up, and we're selling, right? And then we're following it up with another sell usually, or a 4-way, right? Majors are down, minors are kind of sideways, and we're flipping it. We're going the opposite direction. We're buying instead of selling with the direction it's pointed. Most people will use 1 or 2 of those approaches, and there are very few of us that will use all 3 and are well versed in all 3. Nonetheless, it's whatever fits you, whatever fits your risk appetite, your personality, your trading strategy, right? What you see in the market, right? Look at Jason Hall and I always use this as an example because we're 2 extremes. I use major minor primarily, and then pressure secondarily. I rarely ever stare at TNTs, where Jason is like all about TNTs. And the guy slays it with TNTs. You guys seen the guy trade? He trades awesome with the TNTs, the oranges and the blues. Where for me, it's like, I've said this a million times, it's like spaghetti, right? It's what it looks like to me. I have to stare at it for at least 15 to 20 seconds before I get a good understanding of what it's saying. where the major, minor, and pressure, I can literally glance at it 1 to 2 seconds and know exactly what it's saying. I'm trying to think if the gentleman's on with us today. I was doing a coaching session with a gentleman that we just signed up, and I told him, you know, at some point, I want to get you to a point where you just glance at these and know what they say. And he says, you know, they looks confusing. I said, I understand. Just focus on a 60-minute, just a, you know, 1 or 2 of these indicators. And I said, you know, I've been staring at this for a long time. I can glance at them and I can take a trade. So he called me on it. It never happens. He calls me on it. He's like, okay. So I'm watching, I'm on his screen, right? Because I'm doing an onboarding. So I'm setting up his charts and stuff. He says, okay. So we don't have green chart up at this point. He pulls up green chart, and just like this, he says, all right, so green chart is minimized, and he pulls it up, and he says, and I'm looking at all the charts, so I'll show you exactly, because it's kind of funny. So they look like this when they're up. And so he minimizes it, and he says, okay, pulls it up like this. All right, what would you do? You guys laugh, but I told him, well, I would definitely sell based on what happened in the last 2 candles on the 60-minute chart and what the 240 is saying, but I definitely want to wait for the 5 minutes to get overbought. And so he goes, okay, so he goes into MetaTrader 4 that I just set up for him, and he puts in a sell. And he goes, how much do you want to sell for? Well, you know, I didn't really get a good look at it. Let's just scalp it for 5 pips. He's like, okay, I'll put it on a 5 pip scalp. And then he opens up the charts, and I said, yeah, you see that? So I'd want for the major minors to be at least a little higher in the channel or overbought in order to sell. So then they get there, and he goes, so what would you do right now? I said, well, now I'd sell. And he says, well, we're already in a sell, and we're like 2 pips upside down on that side. I said, I know, but this is where I would actually sell. He's like, okay. So we put in the sell. So 5 minutes later, that secondary sell came out, and it grew by 2 pips. So I was like, you can just put it for 7, right? Because I was taking 5 on the initial. I got 2 pips of positioning, so I'm like, just take that one for 7. So I came down, took the 7, and then about 10 minutes later, I took the other one. And he's like, yeah, I'm sold. Now he's a believer, right? But it's like, and it's like this. When you're in kindergarten and you get a book, you can read the book 1 word at a time, right? The pig went to, right? And that's where a lot of you guys are, and that's where I was when I first learned how to read the indicators. I was reading it 1 letter at a time, 1 word at a time, right? Sounding it out, figuring it out, right? But after you practice and practice and practice and practice, after a while, you can just jam right through it, right? You kind of feel like you're in that Billy Madison movie sometimes. You're just like, today, Junior, right? Just read the sentence already, right? So it's kind of like that. But it took us a long time, for those of us that can read them that way, it took us a long time to get to that level. It's not something that came overnight for sure. And you can't measure it in terms of, well, I've been around for 5 years. So, well, Hiram's been doing this for 5 years, and that's why you can read the indicators that way. Well, that's not the case. It's the amount of hours that I put in within those 5 years, because you could put 1 hour a day for 5 years, where I put about 10 hours a day for 5 years. So, you know, kind of do the comparison then there, right? There may be people that I've been in this organization with for the same amount of time, some of them perhaps even longer than I have, but I've definitely put in more hours than most into just staring at these things and obsessing over them, you know, until I figured them out. And part of that is taking a very simple childlike approach to it, not feeling like because I did take that approach where I thought like, okay, I've got this nailed down, I got it figured out. So you kind of close your mind, you live inside this box, and you kind of bounce around in that box. You may get very good at things, and we have tons of traders within our organization that live within those boxes, and they kill it, right? So don't be afraid of being in your box. That's fine if you're winning in the market, right? And that's where you're comfortable. So I'm not trying to discourage you guys from that. But if you're not, and you don't feel like there's anywhere else to go, you're wrong. The sky's the limit. There's plenty to go. Right? I mean, you can spend a lifetime trying to learn this stuff. I learn new stuff about the indicators all the time. Right? Matter of fact, when I stop talking, Cameron will probably show me something new. So again, it's about identifying who you are as a trader, not necessarily the cookie cutter approach, right? And patterns are the cookie cutter approach, right? They are. because we're all capable of seeing the market that way and executing based on how we identify the pattern. And the only difference between one trader and another in pattern trading is your ability to identify a good pattern setup versus one that's maybe questionable in your mind based on your experience in back testing, right? Which, by the way, I'll tell you this real quick, and then I want to give Cameron a second. If I back tested, say, the Hiccup or the Hydra, let's just say the Hydra, I back tested the Hydra, and I wanted to be real specific about when I back tested the Hydra. So I just back tested it for the times that I normally trade, right? And to see what the results were, because maybe the Hydra just doesn't work very well at a high likelihood when I'm trading, right? The only way to find that out is for me to go back to just the times I trade and try to find when the Hydra happened during the times that I trade. So I get a result that tells me, if the, pressure is not looking a certain way when the Hydra happens, I'm not going to take it, right? And I share that information with somebody else who trades at a completely different time than I do. And they take that information and they try to run with it. But it doesn't apply for the time that they trade. Is it going to be as effective for them as it is for me? No, right? So that's why when we backtest, we always backtest every situation, scenario, time frame, announcement or not, whatever it may be, and try to get them to a 90+% accuracy. And that's why the pips are generally pretty low. But I've got guys that have gone back and backtested quite a few patterns for the times that they trade, and I'll tell you what, they're not taking 3 and 5 pip trades on the patterns, right? So they've made them their own. Okay, so it's not a cookie cutter anymore. They're taking those entries, but they're adding other disciplines and putting the weight on those other disciplines in combination with the entry or with the recommended, entry. So getting beyond even patterns and going into even reactive trading. Well, if I compared the way I reactively trade the way to, like we said before, Jason reactively trades, my reactive trade is based on major, minor, and pressure, where Jason's is based on TNTs, right? Predictive trading, I can compare my predictive trading to the way Dale predictively trades, and his predictive trading is different than mine, right? So we're all unique. We see things differently. That's why a coach can't necessarily teach you exactly what it is that they do, because it's not duplicatable. A lot of it is based on instinct and experience. So we're deduced to just kind of having patterns or whatever it may be. Ultimately, it's up to you to determine what you're familiar with and then build around those things. Because that's where your strengths are. Some people will say, well, become well-rounded, right? Work on all your weaknesses. Well, you kind of thin out your process then. You kind of thin out things and you never become, you're jack of all trades, master of none. But if you can master one thing, you're a master. And in the market, that means money. And I don't know about you guys, but that's why we do this. I mean, there's other reasons. We won't go into that. I'll let you guys figure that stuff out for yourself. But that's initially why we started doing this, right? For money, because we think that money is going to get us where we need to be. All right, with that, I'm gonna let you guys sit on that for a minute, because then I'll go off for another 30 minutes. Cameron, show me what you got, man. Explain this to me. I want to see this. I want to hear this.
All right. So basically, all I've done is on ID15, I'm displaying subgraphs. What are they? 3 and 4.
Okay. So those of you guys that aren't familiar with the inner workings of Green Chart, I need you to close your eyes for just a second, because if you guys try to do this and you mess something up, you're going to mess up your indicators. You're not going to realize that they're messed up because you probably don't calibrate. By show of hands, really quickly before I do this, does anybody calibrate their indicators? Good, good, good. 2 of you guys. It's about 1% of the room. Good. No, so here's the thing is that if you don't calibrate and something is messed up, you won't know it, right? The easiest way to calibrate is find a trading buddy, right? Let's go 2 by 2 here. So find somebody that you trade with normally, or when you're on it, ask the moderator, hey, can you line up your charts, snap back one, you snap yours back one, and make sure that they look the same. If they don't, You want to try to figure out if it's yours that are wrong or theirs that are wrong. For those of you that are mastermind members, you'll find that a lot of times your charts will be more accurate, but slightly different than most of the other coaches, because they don't have their time set to 2110 seconds. They have their time set to 2101 minute. So we have a 10-second delay, which gets us to the post 50 seconds earlier. They've got a 1 minute delay, which gets them there 50 seconds later. And a lot of times that'll make a vast difference, especially if there's large movement in the first 10 seconds of the new candle. Okay, John, absolutely. It gets easier with a lot of hours, but it can be easy right now. You just got to simplify it. If you're overcomplicating it, that it'll get difficult. Again, focus on one thing, master it, and then move on to the next. That being said, Cameron, back to you, ID 15, and we're doing SG1.
Subgraphs 3 and 4. Just
3 and 4? Oh, that's right. Okay.
Switching from hidden to line.
Yeah, I know what you're doing now. Okay. I'm not going to tell you guys what this is doing. I'm just going to do it.
I did turn on my value labels, but I quickly discovered they don't change. They're always fixed at 25 and 75.
So they're supposed to be.
Yeah.
It's a force of habit, I guess. Okay. All right. So you, okay, go ahead.
With the majors and minors, the minors, the thresholds are the red and green, or the red and blue that we always see.
Right.
But with the majors, they're constantly moving. It's like a channel that's always shifting.
Major overbought, oversold are always shifting based on volume and volatility in the market, correct?
So when we're looking at the majors and minors, like for a really good example is minor divergence.
Yep.
You get minor divergence, and you've got the minors way into the channel, and the majors not so much.
Right.
But
so
like this one right here, the majors haven't even crossed their threshold at all.
Right. Still majors. So what Cameron is saying is this becomes relevant when you have major minor divergence. So a good example would be like a gray dagger, except most of you guys are identifying gray dagger based on minor overbought, oversold, and not identifying where major is, which is fine, because generally that's going to be just fine. If you guys try to complicate the process with the overbought, oversold of the majors, you're going to find yourself in a world of hurt, because again, you haven't mastered the things that you're currently working on. So don't add anything new yet, right? That's why I
a little more advanced.
Right. Okay. So what's the next step? Now we've got we've got divergence here, obviously, which is indicative of what we see with head fake and hiccup.
Yeah. So this one, I would say it's going to stay short. We're looking at 60 minutes. So where's your two?
Oh, so I don't have them.
All right, looking at the 240.
Well, it's yeah, it is linked. Yeah.
Yeah, the 240 says down anyway. So yeah, you might get a little bump up, but you're going to get more push down.
Right. And so in those situations, it's easier just to use a 5 minutes at position, to see if you can get any positioning out of that. If you can, then you try to use the positioning. Otherwise, you just suffer the drawdown and take the short. Now, obviously, something like this is going to be contingent on volume in the market. Are we looking at just divergence? And if we are just looking at divergence between major and minor,
not just divergence.
Okay.
It's what I noticed a lot of times when I get minor divergence, I'll see it cross the threshold, and then we don't get the rebound we're expecting.
So we see it cross the threshold, but we don't get the rebound we're expecting. So again, kind of some of the disciplines that we see with head fake, right? We got minors crossing the threshold, because this is the minor threshold. It's not the major threshold. Majors are hanging back. And when the majors hang back and the minors cross that threshold, the only time that we see majors catch up and do what minors are doing is usually off hours, when that market's banks are closed, or there's some type of announcement or something happening, right?
See, that's the thing I noticed is if the majors do cross the threshold, but it looks like it's a head fake or a hiccup, the majors will just continue on through the channel.
Yes, if majors cross the threshold.
But it's not just that red threshold, it's their threshold, the one that's down towards the bottom.
So statistically, even crossing that threshold in like a head fake scenario with green on bottom, that's not the case. But with green on top, even short-term bias, yes, I would agree. that when majors cross their own threshold and kind of reach up, you'll see some follow through. It's soft, but soft is relative to what we've seen short previously, right? With the exception, of course, of change in direction or change in trend. But if you're using your longer term charts, like Cameron kind of alluded to a moment ago, you'll find that you'll get a more consistent readout when you get those particular patterns. In this case, Cameron's saying we still got the short here, and we've got majors hanging back with minors kind of pulling up, passing the threshold. We're not really looking at pressure in this particular instance. I think that's kind of why Cameron said you might get a bump up because green popped on top, but overall speaking, we're likely to still get that pulled down. So let's go forward because we see that divergence. Majors are hanging below their threshold, and minors have now crossed into the channel above their threshold. And there's a short.
So that's more useful is when it really does cross the threshold.
9.2. When the minors cross the threshold?
No, when the majors cross their moving threshold.
Oh, you're going to see.
It moved up into the buy channel.
Yeah.
Even if it stayed below the minors.
Minor threshold. Okay.
That's when it really makes a difference. Because that one was just your classic head fake, and it was pretty obvious it was going to go down.
Right. Okay. I see what you're saying. So we're looking for more reactive trade, right?
Yeah, this basically it tells me when your head fake is going to fail.
I see. Okay. Got it. So let's look at this particular instance. Well, that's kind of a soft one.
Into the channel, we've got widening pressure, but we still got down on the 240. So this is one of those where it might come up a little bit and then keep going down.
Yeah, and we see that. We usually see that sideways movement as a result of that as well. So we get up for about 4 pips, 4.5 pips, down for about 12, and then we get that recommitment to the short side, and then a reversal. Total, that would have been about 18 to the short, and then thus far about 6.7 to the long, plus some follow-up. So there's about 17.3. Okay, let's look for another example here. Not a good one yet based on what Cameron said. What we're talking about is, see this thin blue line right here? I don't know if you guys online can see it or if you guys in the audience can see it, but it's represented by this value of 75. It's this thin blue line right here. Can you guys see that?
This is another one where it's kind of, you see your classic double cross down, but since the majors haven't crossed any threshold, this is one where I would take a sell trade on that.
Right. So what Cameron's saying is that this is like almost your classic pattern. So can anybody tell me why this is not a classic? Anybody? Nope. It's just that green's on top. That's it. Green is on top. So it's crossed down. We want green to be on bottom of red for a classic pattern. So Cameron's right. In a situation like this, we got majors and minors pointed up, green on top. It's been on top for a while, but it's pointed up on top, and we've got cross on major minor, and you'll notice that the majors are not extended beyond their respective threshold. Minors are kind of touching theirs. With pressure being on bottom, even a situation like this, we're still, 80-something% likely to get a short for at least 3 pips. And not to say that this won't short, but what Cameron's saying is based on his experience, he would sooner just sit this out because statistically it's not going to be profitable for him. Even if you win some of them, the losers are going to outweigh the winners. Good call, Cam. That moved it's moved 7.7, but it moved 40.3 in the opposite direction.
See, and now it is crossing its threshold. It's gone past that thin blue line.
Yep. So now majors are crossing its respective threshold.
And it agrees with the longer term charts going down.
And agreeing with the longer term charts down.
Yeah.
Minors are pointed up. Just off chance, anybody know what this pattern is? You got it. Bootleg. The only problem with it is obviously pressure, but nonetheless, it's kind of what we look for, right? With a bootleg, majors down, minors up.
I wouldn't think of this only a few pips because we're looking at a 60-minute chart and we don't have a 120 yet.
Yeah. So 60-minute, we've got about 16.8 of retracement just on that right there. So let's just take 8. Let's see if we can get 8 out of that. Let's try to do a 3 to 1. So that's 24 to the long, 8 to the short. 16.2. We got double.
Can we do one more quick?
Yeah. Boom. Look at that.
That's what you get universal.
Yeah, that's what pressure eats your lunch. Absolutely. Yeah. Okay, so let's look for another example here. So what we're looking for is majors to reside below its respective oversold. This thin red line right here that's 25, or this thin blue line up here that's 75. So now we're below. Now we want them to kind of cross for a reactive trade, meaning they're going to point in that direction, and the tips of the green and red be above this thin red 25 line right here. Nope, not yet. Not yet. Not yet. There we go. So majors are in the channel now. This is kind of soft, but they are in the channel now. Minors are kind of sideways with that pullback. Pressure is kind of sideways as well. We got a doji.
And the longer term chart's still pushing down. This
Yep.
you probably want to take a pass on.
So pass. So you're saying because longer term charts are still kind of pointed down, take a pass on that one. So it's still small up based on the same principle, right? 3.1, not enough to get a 3 pip. Let's see if we'd be able to squeeze a 3 pip out of that. 2.9, no, 3.8 to the short. Just keep on going with this.
So essentially, I just use those thin lines to fine tune my read on the majors and minors.
Nice. So it's just a way to fine tune the read. I like that. I like that. This is super useful if you guys know how to use it correctly. Otherwise, it's just going to mess you up, right? So part of psychology is, you got greed, boredom, overanalysis, right? Overanalysis, which is something that I'm guilty of pretty often, is when you've got all these processes and approaches, and sometimes you're trigger shy. Josh, aren't your long-term charts you're reading off of the wrong day and time? This one we're not using. That one we're not using. That one we're not using. We were only using the 60, the 240, and the 5 minute.
240 though, it's August 27th. The other one's May 31st.
Oh, it is not correct. Sorry, Cam, I had you set up for failure there. Thanks, John, and thank you. Appreciate it. Cam's like, it's still showing short.
It's stuck there.
It's stuck.
We stayed pretty close to the same range, so I thought we were still within the same two.
Yeah, it did kind of stay within that. All right, there we go. Okay. Let's see here. And now all those are linked. So you've got, all these different, in overanalysis, you got all these different things that you're considering before you take a trade, right? And sometimes you take a couple of losers and all of a sudden you're on tilt and you feel like, I'm really skeptical about getting in the market, so I'm not going to take a trade unless I see the absolute perfect setup, right? Or you watch it on it and then all of a sudden you look at the on it, you're like, well, I wouldn't agree with that, but the coach said to do it, so I'm going to do it, right? And it just so happens to be the time the on it loses, right? Or whatever, whatever it may be, right? So you start second guessing your approach, and as a result, you start trying to find the easy pill, right? So you start looking for different processes and approaches that are going to help fix your bad situation. It's a situation. It's not your whole trading history, and it's not everything that you've established to that point and practiced and studied and mastered. It's a couple of losers that threw you off your game, and now you feel like you just don't have it figured out anymore. You lack confidence, and it's more of an emotional move than it is, a logical. And you need to have a good balance of both. So you start overanalyzing, right? You say to yourself, okay, well, I want to see all these different things come together in one just beautiful linear path and pave the way for me to take a trade. And usually most of those things are reactive, right? So I'm gonna explain to you guys, some of you guys, your exact situation. The only reason I know this is because I've done this before. I say, okay, I want this to happen in the 5 minute. I want this to be in the 60 minute. I want this to be in the 240, all simultaneously, right? And a lot of times it's reactive because I'm like, okay, I can't trust my instinct. I can't trust what I used to see predictively because I'm losing it all, right? And really, I'm not losing it all. I just lost a couple of trades, and if I was better at protecting them, I wouldn't have lost so much, right? So I'm ignoring the elephant in the room because that's too difficult. I don't want to address the fact that I should have stopped those trades out 40 pips ago, and instead I'm still in that trade, right? So I ignore the elephant in the room, and I wanted to figure out a new, better, innovative way to win, right? Even though prior to those losers, I've got a great win rate, but I'm not paying attention to my great win rate. And the elephant in the room that's telling me just control your losers and you'll be just fine. I want to figure out where the easy pill is and how I get something that I can ingest really quickly, and within 15 to 30 minutes, all my symptoms are gone, right? So you start overanalyzing. You start saying to yourself, okay, I want to see these exact things. Until I see those things, I'm not going to do anything, right? And usually they're reactive. And what the problem is that when they are reactive, generally when all those things line up the way you want them to, the move is over. You just don't realize that because you're not well versed in the indicators yet. So a lot of times you say, okay, all these things are lined up. That looks like a great trade. I'm going to execute all these disciplines that all these coaches told me that finally line up the way they should, and I'm going to take that trade. Not realizing that some of these coaches are giving you something that's predictive, others that are giving you something that's reactive, and maybe even some pattern based in there, right? You're just kind of mixing it all together like this melting pot and thinking, well, if I just do everything that all the coaches tell me, that's going to be a bet the farm type trade, and it's going to get me out of all my problems. And generally, when things line up that well, it's time to start considering the opposite direction, right? Generally speaking. So you find yourself just kind of compounding this approach, and so you continue to try to heap on other disciplines, right? When eventually your charts, you've got 15 different charts up for one currency pair, you've got 1 million lines in there, you've analyzed everything you possibly can, and this little sliver right there, if the market ever gets within there and does 15 other different things, then you'll take a short for 3 pips, right? And that's where you kind of find yourself, and then you get frustrated because those things don't happen. Where you could literally just kind of go rewind time, go back to when you had things simplified and easy, accept the fact that you're going to have some losers, that all you have to do is control them and you'll win more, right? We did a session not too long ago, I think it was maybe 2 or 3 weeks ago, where we talked about how just mitigating your losers is going to make you more profit, right? So I'll give you a quick example. Let's say you're trading at 70%. I don't expect that my members, which is you guys, are going to trade below 70%. And I'm not just saying that. A lot of you guys already trade at 80, some of you even 90%. But I mean what I say. So let me go here really quickly. Yeah, Joe. So the difference between reactive and predictive, reactive is when you're looking at the indicators reactively, if they're pointed in a certain direction, that's the direction you trade if you have enough analysis, if you have enough validation. So it's a very simple, superficial way of reading the indicators. And they work reactively, just like any other indicator in the market, but faster. Reactively, like any other indicator, meaning if they point in that direction, that's the direction you trade. I probably wouldn't recommend taking this particular trade just because it's probably an announcement, considering the time and how fast it reacted, and all of a sudden these lines are starting to point up. That would definitely need more analysis, but this is kind of an example, right? Majors and minors pointed up, maybe if they're a little below overbought, but pointed up, pressure agreeing, then you're pretty safe to take a reactive trade in that direction. A predictive would be more like a hiccup pattern, where hiccup pattern follow-up specifically. So I'll show you really quickly. Let's go to 16. So a hiccup pattern where you've got green down, red up, overbought, miners crossing. They take the bait. They think the market's going to sell based on technicals and all the other garbage that they use. Short-term bias and pressure, contrary candle, we're going to buy, which in and of itself is kind of predictive, right? Because nothing about these lines say that they're buying. Only 1 out of 4 of these lines is pointed up. Red's up, green's down, gray and black are down. The only other thing in pressure is green on top, and both of them pointed up. However, there's a lot of divergence, right? Even the thick orange and the blue dotted have completed their chomp and are signaling short, almost, and kind of sideways there. 3 out of 4 saying sell, majors hiccuping, minors saying sell, divergence in pressure, which usually is indicative of sideways, which actually helps us in this particular instance. But for the most part, this would be kind of predictive because it's not really pointed up or down. It's kind of sideways, if anything, but we're saying up. More than that, we're saying when these are pointed up after a hiccup or a fake out pattern, we're going to sell. Even though we know 60 to 70% of the time, we might still get a little bit of buy out of that, which is where we'd use our 5-minute to kind of position that, right? Wait for the majors and minors to agree overbought and then try to sell after that. But let's disregard that for a second. Let's just say we're going to sell. And then after we take this predictive, right, because green and red are up, minors are up, green is up, red is up, we're still going to sell or position to wait for a sell. But we'd sell right there, barely get any sell there, but we know that the follow-up is going to be sell as well. Not just because of the bootleg, but also because generally after that sell, we get a reactive trade, which is majors and minors crossed, overbought, pointed down, so we sell again. So another example would be like a head fake. Head fake, these look like they're pointed up, and they are, but we'd actually sell based on the parameters that actually Cameron was just talking about a moment ago. The oversold to the majors are below their respective oversold. Minors have crossed into their channel. Pressure is short-term bias in our favor, and we got a green candle. Everything about this is more saying buy than it is sell. Look at TNT's buy, 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 sideways, buy, buy. Major pressure is pointed up even though green's on bottom. A lot of that says buy, but we know that we're going to sell because we understand the indicators. And then because of that, because of the fake out, these lines pointed down tell us to what? After the fake out. What are we going to do? Buy. Doesn't make any sense when you look at it logically, but we're not looking at it logically, right? English, the language English doesn't make sense logically, right? Certain words, I'm like, why is that pronounced that way, right? And nothing makes sense in English sometimes. We just know how to speak the language. It makes sense to us because we speak the language. So when you speak the language, then you get over the fact that sometimes it's not logical, but it's just what it means. That's how you properly communicate, right? If you speak another language and you speak slang in that language, people that just learned that language may not be able to properly communicate with you because logically it doesn't make sense, right? If I used slang for English and I called something, if I said, oh, that's the shit, right? Well, if you know what that means, you're thinking, well, is it you don't like it? Well, no, it's kids saying that that's a good thing, right? It doesn't make any sense, but you're communicating something correctly. Yes, sir.
Well, okay. What about those buys in that previous candle told you to buy?
What about the buys? I'll break this down for you.
The previous candle, everything's up, like you said.
Yeah. Why? So here everything's down. Why would we buy, right? Why is that telling us to buy, right?
Yes.
So I'll explain it to you. So I've done this a million times, so I can do it off the cuff. And for those of you guys that have ever had a coaching session with this stuff, you know exactly what this is. Let's look at the market as a scale, right? Zero gravity in the sense that there is no up or down, right? Because up for one currency pair is down for the other, right? So it's just kind of, we're in space, right? But let's look at it like a scale instead, which obviously there's gravity in scale, but you understand what I mean by it's not really relevant up or down, right? Okay. So if I put more weight on this buy scale, then the market buys. So that means if more people are buying than they are selling, the market will buy. Okay. Now, if I have equal amount of weight on the buy and sell side, and I remove weight from the sell side, the market buys.
Yes.
And this vice versa. So if I have more people selling than buying, then the market sells. If I remove weight from the buy side, the market sells. Even though more people are not selling, it's just people are getting out of buy positions, which is counterweight because it's a zero-sum market, right? So in order for me to buy, people have to sell. In order for me to sell, people have to buy. So by deductive reasoning, if people are getting out of buy positions, the market will strengthen to the sell side. If people are getting out of sell positions, the market will strengthen to the buy side. Okay? So then, if I'm the majors and I want to continue to sell, but my pan is all the way on the ground, I could continue to add weight to that sell pan and it won't move the market anywhere because there's no one putting counterweight. The pan is on the ground. It's as far down as it can go vis-a-vis oversold. Okay? So now we're oversold. I'm the majors. I'm not going to play against other majors because they have just as much money as I do, and that would be an all-out battle to the death where both of us would essentially lose lots of money. So instead, the majors make a handful of people, a handful of organizations where professional day traders are millions. So it's ants, grasshoppers versus ants. Grasshoppers can use the millions of ants to do the work that the grasshoppers otherwise do, right? So then they teach you things in the market to react to, and so that they can take advantage of you. So it's like going to Vegas. Who sets the rules in Vegas? The house. Are the house set in opposition to the house? No, it's always in favor of the house, right? Okay, where do you think most traders get their information about professional day trading? From the house, right? I trade with E-Trade. Well, good job. Guess who that is? The house, right? And is that who you learn how to trade from? Awesome. Good luck to you. Right? And some people make it work, and they do. They figure it out. They make it work. And that's great. It takes them 10, 15 years to figure it out. But if they figured it out, fine. More power to them. Awesome. Job's just easier for me. Anyway, so we're oversold now. The majors have to get the miners to buy. So majors teach miners certain things. And that's why I'm always reluctant to use things that are common in the market, with the exception of timeframes. I like the most commonly used timeframes because then I can see how the majors manipulate the miners, because the majors know what the most commonly used timeframes are, so they're going to manipulate them on the most commonly used timeframes. Okay, but I'm not going to use, not that I'm against them, I think people do great with them. I'm not going to use pivot points. I'm not going to use Fibonacci as aggressively. I'm going to identify with my site support and resistance and only trade a certain percentage within that range. All right, so I've got to wrap this up really quickly because I only got a couple more minutes. So if I want the miners to buy, or to buy because I want to continue to sell, then I got to trick them into doing so. So I got to do something that's convincing, right? Pull the market back. This is your traditional, I mean, just ironically enough, this is a traditional reversal candle. For those of you that ever traded before, a lower high and a higher, a lower low and a higher high with body is indicative of a reversal candle on H1 time frame, H1 being a 60-minute time frame. For those of you guys that used to trade before that and know this, you know that that's true. I'm not just making that up, right? There you go. That's one thing that the majors teach you. So forget that, because right here, I can see that the majors are telling them, trying to get the miners to buy. So sometimes what the majors will do is take weight off of their side, which is the sell side. They'll take weight off of this side, right? Because they're not going to take weight here, put it here, and then put it back, because that's, you're playing against yourself. You're moving the market yourself. So instead, you take weight off at a certain level to make a certain thing happen. So the miners say, oh, it's time to buy. We can see that the miners are buying now. When the miners cross and point up, it means something different sometimes than when the majors cross and point up. More importantly, if they're crossed and pointed up, and then on the next candle, they're crossed and pointed down, that absolutely means something differently than when the majors do it. When the majors do it, it's intentional. When the miners do it, they got stopped out. Okay, that's the dichotomy. So watch what happens now. Miners, what happened to them? They were crossed up before, now they're crossed down. One candle to the next. Majors also, however, majors did it intentionally. So remember that money that they took off of the buy pan so that the market would come back up, and the miners would put their money on, or off the sell pan. Miners put their money on the buy. So then the money that the majors took off of that to cause for that pullback to happen, and then the miners bought into it, then the majors say, hey, remember this pool of money that we just kind of cashed out? Let's throw it back on there. And when that happens, it pulls the market down. Now, when you're trading at a 1-to-1 ratio, because at a 60% win rate, you have to do the math. If you're trading at a 2-to-1 and you're taking 10 pips, six out of 10 times, you're making 60 pips profit. 4 out of 10 times with a 2-to-1, you're losing 20 pips. What's 4 times 20? 80. What's greater, 60 or 80? That's a losing approach. So they don't do that. They trade at a 1-to-1. If I'm taking 10 pips profit, my stop is also 10 pips. Therefore, when the market shoots down, something like this, 16.7, and the miners all of a sudden are crossed and pointed down, that's because they got stopped out. Not because they said, whoops, let's sell instead. Okay? Majors are now selling and miners are getting out of buy positions. So what happens to that pan? On the ground, right? Where are we? Oversold, right? Where's the only place we can go from here? Up. That's why this is predictive. This is why it's valuable to us, because we're the only ones that can see this. You have to be part of this organization to see this. You can't see this if you're not. You're very welcome. So we know that 60 to 65% of the time, that's still going to sell a little bit. That's why we can use our shorter term chart to position. Otherwise, we just buy, because 90+% of the time, it's going to buy within that range. So we took 3 on that one. That's only 7.6. Now we got a reactive trade. Majors and minors both crossed and pointed up after the head fake. So we don't need a classic. In other words, we don't need green to be on top because it happened after the head fake. Just like the predictive trade. So pattern-based, predictive, because we're not trading. I mean, this pattern-based is also kind of predictive, right? Because it pointed up, we're selling, and now we're buying. And that's indicative of the majors too, right? We're going to get you to jump from one foot to the next, right? So then we buy, and then we got a reactive. So pattern, predictive, reactive. Now we buy again. Like magic. So it's a mix of things. We understand how the market works and how our indicators corroborate with that, and that makes us more effective. So it takes time to get there, and it's okay. Right now, wherever you're at, master that. There's plenty to grow, right? You got plenty of time. I built my account knowing a fraction of this stuff that I'm teaching you guys today. And the only reason I teach this stuff is because I want you guys to be able to do it faster than I did. All right. I got to end with that because I want to give Mr. Parkin his time. You guys are in for a treat. Hang out for that. Hey, guys, remember, before you guys go, next week it's going to be 7 p.m. for the mastermind, or for the Proving Ground review. We're not going to do the 6 p.m. to 7 anymore. It's going to be 7 p.m. to 8 p.m. So if you guys show up at 6, you can probably come to my office and chat with me for a while, but we're not going to start until 7. Have a good night, guys. Thanks.
Your chart set for 10 seconds after the top of the hour.
I do.
Or
yes, after the top. Yeah. Every yes, every time.
You're welcome to enter the drawing. Now, the winner will be chosen at 8 o'clock.
Thomas, what does that mean? Like, succeed. How the heck does that say succeed? Not sure what that means, my friend. I'll hang out here for just a couple seconds while I shut down. If you want to clarify, I'm not sure what that means. Oh, how are you, sir?
How you doing?
I'm doing good. So we're going to be moving this advanced, as far as I know. English doesn't make sense. Oh, yeah, Thomas, right? It doesn't make sense, man. Yep. But it communicates, it communicates, if you know English and you know the word, you're properly communicating. And that's kind of the indicators. They're the same way. Even though they don't make sense logically sometimes, they're properly communicating something. It's just a matter of whether or not we speak the language. All right. Thanks for the clarification, Thomas. I'm going to shut this down, and Matt Parkin's going to set up. You guys have a good night. Thanks. Sorry, man. I'm a little bit late today.
No worries. So the advance is doing what?